Welcome to Market Week in Review for the week ending March 10th, 2023. I'm Sophie Antal-Gibert, and I'm joined today by Portfolio Manager at Russell Investments, Olga Bezrikov. Hello, Olga, how are you?
Hi, Sophie. I'm really well, thank you. How are you doing?
Very good. I'm looking forward to hearing from you on a couple of things. One, please help us look into the mind of Chairperson Jerome Powell, Chair of the Federal Reserve. There's going to be a Fed meeting in 10 days. Would love to know more about what we might expect there. And then also, we got some 4Q GDP numbers out of Europe that I'd love to get your thoughts on for global investors. Sound good?
Definitely.
All right. So take us into a journey into the mind of Fed Chairperson Jerome Powell. What does that look like right now? What is he paying attention to? What do you think is going to happen in that next Fed meeting? We got some good data this week, both from him and from data releases. What is that looking like? What are you keeping an eye on at the moment?
So Powell has a really tough decision to make at the upcoming meeting. The expectations are that the Fed would slow the pace of interest rate hikes, but this has changed dramatically over the last week, as we heard from him in his testimony, as well as got a look at the hard data coming out of the US employment. So all eyes were on the chairman as he delivered his policy testimony before Congress on Tuesday and Wednesday, with market participants hoping that it would provide an insight into his thinking. Now, what really stuck out to me is that a point that he has made once again is that a reacceleration in tightening is still on the table. He stressed that jobs and inflation data will drive the decision making on further hikes, which is why this week's hot employment data has led to a lot more market volatility as investors are trying to parse out what does it mean for the next hike. Now, based on his testimony, I have to say that it's very unclear whether at this time the Fed is leaning towards another 25 basis points or towards reaccelerating the pace and delivering a 50 basis point hike. This is why this week's data has been so important and engaging for the market participants. Now, as we headed into the week, expectations were for moderation in US job growth, which could afford the Fed some flexibility around the pace and magnitude of further monetary tightening. And then on Tuesday, we got the ADP payroll report that showed that the Fed's aggressive efforts so far have not really worked to cool the labor market as planned. We saw the companies in the US adding more jobs than expected. On Wednesday, we got a look at the jobs openings, which also came in on the hot side. This is indicating that the businesses are continuing to hire, even if we are seeing some headlines from tech companies like Meta announcing further layoffs. And then finally on Thursday, data showed that weekly jobless claims came in ahead of expectations, which has been interesting. Now, even though this is the first time that the claims surpassed 200,000 since early January, this is fairly subdued by historical standards, and particularly, it is lower than what we tend to see during times of cooling labor markets. Now, the reason that this is important is that it means that everybody is watching the employment report on Friday. And as economists are projecting a 225,000 increase in February payrolls after a blowout report in January, we really need to see how it comes in relative to the expectations. If we continue to see strong numbers, such as this week frankly has been indicating, it may mean a stronger case for a bigger hike at the March meeting. If the numbers come in softer, the chances of which have been lowering a little bit, expectations might shift back to 25 basis points. Now, this is the last jobs report, so everybody's looking for clues on whether the economy can even handle more hikes.
You definitely have me sitting on the edge of my seat. We are recording this on Thursday afternoon, so we will find out tomorrow, along with everybody else, what the actual jobs number ends up being, and we'll definitely tune into Market Week in Review again next Friday to understand what we might anticipate from the meeting the following week. Thank you for that. Maybe we can pivot to another central bank, the European Central Bank, where we just got data for the fourth quarter of 2022, GDP growth information there. What is that looking like, and what decisions is the ECB facing as a result of that fourth quarter GDP growth number?
Yes, of course. So the eurozone economy showed no growth in Q4 of last year. We got the final numbers, and even though preliminary expectations were for a very modest growth, the final numbers indicated that there was no expansion. This is the first quarter that this happened since Q2 2021. So it is definitely concerning around the health of the European economy. What we also got this week were the European retail sales, which advanced in January following the contraction in the previous month. But this expansion was more modest than what the markets expected. Despite the slowing economic data, which definitely is pointing towards some of the risk in the European growth, inflation continues to be a major concern for the region. What this means is that the European Central Bank is widely expected to hike rates by 50 basis points at the next meeting.
All right. Well, sounds like a lot of central bank watch at the moment. Unfortunately, Olga, that's all we have time for today. But thank you so much for your insights and for having joined us today. And thank you for joining us. We'll be back again soon.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.